I'm still very, very bullish. Again, as long as our government can't get it together and stop spending money, and I would love to see cuts in government spending. I think most Americans would. But the question is, will it actually happen? I'm hopeful it will, but until we see it, gold is still the place to go, and really longer term Bitcoin as well. The U.S. economy has stayed strong. We've seen the price action in copper go down because of China and the rest of the world. And I think that just creates this negative aspect to silver. So while people are buying it as an alternate to gold, it's a cheaper version of gold, if you will, there's this obvious need in industrial side. And I think that's really capped the upside here. I still think we're going back to 50. It's just a matter of how long is that going to take before we get back to 50.
Gold has recently seen its biggest monthly drop over a year, holding steady just below critical levels around $2,640. The metal faces tough challenges, with the US dollar gaining strength and US Treasury yields rising, putting pressure on gold prices. While there's some hope that the Federal Reserve might cut rates shortly, offering a potential boost to gold, it's not enough to lift it significantly. Bank of America expects gold to reach $3,000 an ounce in the coming year, but it will likely remain in a consolidation phase for the first half of 2024. Adding to the uncertainty, a policy mix under the Trump administration, including higher growth, inflation, and a stronger US dollar, could reduce demand for gold in the short term. Even with these headwinds, some experts, like precious metals analyst Gareth Soloway, are still bullish on gold's long-term prospects. Soloway sees gold and silver getting solid support in the new year, driven by ongoing economic uncertainty and geopolitical tensions, which should boost safe haven demand. Silver, however, is showing a bit of a different trend. Lately, it's been acting more like an industrial metal, responding to global economic cycles and increased demand from electronics and clean energy industries. While its price action has somewhat mirrored gold, silver has been more volatile and could face additional pressure if the global economy slows down or if demand from its industrial uses weakens. In the longer run, silver's dual role as both a precious and industrial metal could give it an edge, especially as the clean energy transition ramps up. However, silver has struggled to break past the $30 mark, despite many expecting it to soar to $50 an ounce. While there's still potential for silver to reach $50 eventually, this timing is unclear, and it will likely depend on a broader global economic recovery and renewed industrial demand. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
Still looks like it's just hanging on to that bearishness here. And you can see, again, you have your trend line connecting the lows and here. And this really, again, if you look at it like an upside down flagpole, we've all heard about bear and bull flags. This is your upside down flagpole, and this is your flag right here. So as long as we kind of stay in this sideways chop, it still does have a little bit of bearishness to it. But I do think it's an impressive rally today in gold. The dollar's not really falling, so it's not the dollar that's doing it. The question I guess I would have is this because Bitcoin is falling? Are you seeing a rotation of capital, which we've seen in the past when Bitcoin does really well? I mean, what's fascinating about this, just to touch base, the high on gold here, which was your all-time high, was back at the end of October going into November. And what we know is that Bitcoin started its bull run at the elections right here on November 5th. And so you almost get this sense that there's a little give and take where money goes into Bitcoin when it's hot, but then when Bitcoin cools, that money comes into gold. And I think there could be something to that and maybe what we're seeing. But suffice it to say, even having said that, the pattern specifically on a technical analysis basis is short-term bearish, but you do have support here. We can look at this beautiful parallel channel where the highs connect right through here, and you have these lows. And as long as you don't break this, then you would be buying pullbacks on gold here, even if you dip down to about 25.90. Very, very bullish. Again, as long as our government can't get it together and stop spending money. And I mean, I know we've heard about this Department of Government Efficiency, but I have this healthy aspect of skepticism when it comes to anything political, where until I actually see it imposed, I'm not going to believe that it's going to happen, because politicians have a way of wanting to be reelected, and when they make spending cuts and people do more poorly, they tend to not get reelected. So I would love to see cuts in government spending. I think most Americans would, but the question is, will it actually happen? I'm hopeful it will, but until we see it, gold is still the place to go, and really longer term Bitcoin as well. One of the things that I find fascinating, and this is more on a human psychology, like like if you took a poll of everyone, most of them would say, yeah, the government spends a ton of money we don't need to spend. But people aren't connecting the dots that if that spending is cut, it likely means a rough recession, right? You can't, if you're spending X amount to stimulate, essentially government spending generally stimulates unless it's payments on our national deficit, which is just wasted money. But any other spending is stimulative because it's putting money in people's pockets that they then spend. And so are people really ready for a, rough patch if we do cut government spending? I think people say they are, but when the rubber hits the road, as they say, the question is, will they be okay with that? It definitely acts much more like an industrial metal, but we still see that same sort of thing where going into November, when Bitcoin and crypto took off, that's when silver started to come in. Now, again, same sort of pattern. It's not as clean as the gold bearish pattern, but this is your flagpole down and then this sideways chop. And notice how this high-end trend line right here, and I have these lines drawn in just to kind of show the pattern formation, but essentially this line is parallel to this line, and that's where silver has stopped today. So as long as we stay below this 32.15 level on silver, you would anticipate a pullback to the downside here, maybe even a retest here, maybe another move up, and then eventually that move to the downside. And again, I'm still a skeptic on the U.S. economy overall, that at some point we're going to have a recession, whether it's in early 2025, late, or in 2026. You can't postpone recessions forever. There's no such thing as that. We have boom and bust cycles. And so at that point, I would be concerned that silver could take another leg down. I'd be a buyer around 27.75. There's a lot of support there. And again, 5-10 years with fiat currencies going the way they are with printing and debt, I think silver's a lot higher. Shorter term here, I'm a little skeptical based on the price action and the patterns.
I think I myself and a lot of people were thinking when silver gets above 30, then it's off to the moon from there, because there's not much resistance above 30.
Part of it's been China, right? China's economy, and you've seen copper come in massively as well. If we take a look at copper had this bull run early in the year, and then really we topped out in May, and since then it's come right back in. I think that's, while the U.S. economy has stayed strong, we've seen the price action in copper go down because of China and the rest of the world. And I think that just creates this negative aspect to silver. So while people are buying it as an alternate to gold, it's a cheaper version of gold, if you will, there's this obvious need in industrial side. And I think that's really capped the upside here. I still think we're going back to 50. It's just a matter of how long is that going to take before we get back to 50.
Despite the Federal Reserve's efforts to control inflation through interest rate hikes, inflation has proven to be more persistent than anticipated. Although the Fed has made significant strides in raising rates over the past couple of years, inflation has not yet reached the target 2% level. This ongoing inflationary pressure has created a dilemma for policymakers, as the economy has shown resilience, but at the cost of sustained price increases, particularly in areas like housing, food, and energy. The persistence of inflation, despite aggressive monetary tightening, signals deeper structural challenges in the economy, including supply chain issues, labor market tightness, and high levels of government spending. Gareth Soloway highlights the Fed's decision to start cutting rates amid these inflationary pressures, which raises further concerns. Historically, central banks tend to ease monetary policy only when inflation is under control and economic growth is slowing. However, the current situation is different. The U.S. economy remains relatively strong, yet the Fed is cutting rates, which could signal that the central bank is preparing for a potential slowdown or recession. This move, combined with inflationary pressures, suggests that the economy may be entering a period of stagflation, a scenario where inflation remains elevated while economic growth stagnates. This is a particularly challenging environment for investors, as it limits the effectiveness of traditional monetary tools and creates uncertainty regarding future inflation trends.
I think that's the kicker, is there's this beautiful trend line going back to October of 2023, which really was that beginning of this incredible run to the upside, right? And what we saw here is this, initially it got away from this trend line for a long period. It came back, kind of did a double tap, smaller bounce, a little bit bigger bounce. And then what we've seen here is it broke down, and then this line becomes resistance, getting rejected every time it gets up in there. So for me, it's kind of like, okay, maybe we get up to this, 6150, 6160 level, but we just have to look at history and what it's done. And very clearly it rejects it every time. So in terms of being bullish or bearish and risk versus reward, your upside here is less than 100 points on the S&P versus any sort of downside could kind of get nasty. There's not a lot of support down in this range. And so again, if you look at valuations, the Buffett rule metric, I mean, things are so extended. I mean, for instance, the Buffett rule metric that he uses is 2 standard deviations away from the norm at this point. Now, a lot of people will tell you, oh, that's old school analysis. But what I've learned is that when people say that, it's usually they're just trying to justify why valuations don't matter anymore. And inevitably, we've always seen valuations come back to mean something later on. And so again, for me, for sure, I'm definitely leaning more towards the short side, understanding there could be a little bit more upside, but we're probably in the 9th inning of this bull run. What I like to do is just take that same starting point and connect it through those other lows. So taking the August low right here, which was an incredible short-term correction, you would probably be looking at, this line here, and then the market could dip into that level. We could do a quick measurement to see what that would ultimately be from the current levels here. And that would be about a 7% correction. Now, that would just be a short-term pullback to that line. I think you'd get a bounce off of that. The bigger issue would be if we start to think the recession is finally on the horizon of the U.S. markets, right? So as long as, like if nothing goes wrong and the markets keep plodding along, I think 7% pullback is your run-of-the-mill pullback. If we get into a scenario where the economic data starts to weaken significantly, that's where you start to really say, do we break some of these levels and then really start to have the bigger corrections down to these lows, maybe retesting the August low from 2024, which, by the way, I mean, it seems like a big move down. That was only about 4 months ago at this point. It's not that long ago that we were right down here. It's just that we've been on an incredible move to the upside. But I think, again, the key is, can the economy continue to grind forward versus slipping into a recession? And again, that's the tricky thing. And I know we're going to talk about inflation, but my biggest concern is that the economy, we're not back to 2% inflation and the Fed is already cutting rates. And again, that's a concern of mine for sure. My outlook for the economy still remains skeptical that we're just going to miraculously never have a recession. I thought we'd honestly, by the end of this year, I had already talked about thinking we'd be at a recession. Certainly that hasn't happened. I think I was underestimating the amount of liquidity in the system and how much the wealth effect from the stock market is helping the high-end consumer just continue to spend money, which is then stimulative to the economy. And let's be fair, the U.S. debt deficit keeps going higher because the U.S. keeps spending money in so many different places as well. But I think inevitably that's going to happen. History is one of my best guides. And, we're basically at the longest point between recessions that we've almost ever had if you take out the COVID quick collapse that we saw. So you have to look at that as a likely scenario. The question is it in 2025? I do think it gets there. I think that, again, we've seen the low-end consumer, which is, the McDonald's eater. McDonald's has said, hey, people that make less than 50K can't even go to eat at McDonald's anymore. We're also seeing inflationary pressures starting to pop up again. Upticks in inflation like PCE recently we saw as well. And so, you start seeing inflation and the stock market stops going up and the high-end consumer starts to panic and stop spending, and then that recession will come very, very quickly. So watch that high-end consumer, right? And essentially by doing that, watch the stock market. The second that stock market doesn't make new all-time highs every couple weeks, that's when that consumer is going to say, oh my goodness, my 401k is not up another $10,000 this month. Maybe I can't go on that next vacation. And that's where consumer spending overall starts to come in. I think that, one of my issues, and I know a lot of people have raised this issue, is that the Fed has said 2% is their goal target. But here we are at around 2.5%, and the Fed is already starting to cut rates. In addition, you look at coffee prices, cocoa prices, sugar prices, you're starting to see a lot of the food side of things, prices starting to go up pretty dramatically. Now, energy has still stayed relatively low in terms of oil, and oil still looks really weak to me because the U.S. is producing so much, so that helps keep inflation down. But food inflation is the one you can't avoid. I mean, everyone has to eat, and I do worry that food inflation will continue to be passed through to the consumer. In addition, we're starting to see some of those pressures from potential tariffs. And we know tariffs, in fact, Trump just said, I think it was over the weekend, that he can't guarantee prices aren't going to go up when he imposes tariffs. And so that's what I've been saying for a while, is that tariffs tend to be inflationary because, again, if you can buy a widget in the U.S. for $1 or let's say $2 in the U.S., a U.S. made widget, but China would sell it to you for $1, but now all of a sudden you have a 100% tariff on that China widget. Well, now you have no option but to pay $2 for a widget, and that means it's inflationary. So you have to expect inflation to start to pick up again in 2025. Hopefully the economy doesn't go into a recession, because then you'd have stagflation, which, as we know, is the worst of all scenarios. I don't think Trump has a lot to do with it. I think the tariffs, for instance, like if he imposes sweeping tariffs on Mexico, Canada, and China, then that would have an impact on inflation. But aside from that, you're right, money supply and essentially the more money people have in their pocket, the more competitive spending there's done. So for instance, if I want a TV and 100 other people want that same TV, it's going to go to the highest bidder. And so the more people that have money, the more prices can go up because there's more people willing to pay. There's always someone that'll pay a little bit higher. And so the creators or the makers of TVs will figure that out and say, okay, we can pass this cost along because people are willing to pay a little bit more. So a lot of it has to do with how much money people are making, which again is a tough one, right? Because we all want people to make more money and do better in life, but it also is inflationary, which is why inflation generally goes up during economic boom times, because people are making more money during those times. So there's more competition for goods. So I think, again, there are certain policies that Trump will be able to control that could alleviate pressure on inflation. But you're right. From the most part, it's money supply, how much money is in the system, how much money each individual has, and therefore how much money is competing for the same goods.
The outlook for both gold and silver is becoming increasingly favorable as global demand for these precious metals continues to rise. Gold remains a cornerstone of safe haven investing, driven by central bank purchases and heightened inflation concerns. The yellow metal is expected to see sustained demand, particularly as geopolitical tensions and economic uncertainty persist. However, silver is also experiencing a surge in interest, largely due to its industrial applications. Its role in the renewable energy sector, especially in solar panels and electric vehicle EV batteries, is becoming more critical. Silver's superior electrical conductivity makes it indispensable for high-performance electronics, further boosting its demand in both industrial and technological sectors. In addition to industrial demand, silver is witnessing a rise in investment interest. Central banks, including Russia, have begun to accumulate silver, which could set a precedent for other nations to follow. This shift, combined with a resurgence of retail investment and increasing demand from exchange-traded funds, ETFs, positions silver for significant growth. Silver is seen as an undervalued asset with substantial upside potential as the gold-to-silver ratio remains high. If this trend continues, investors could be presented with a unique opportunity to capitalize on silver's dual role as a precious and industrial metal. Please share your thoughts on Gareth Soloway's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.